Hey, what's going on? Steve Peterson of Infinity Investments. And in today's video, we're going to be talking about the 5 keys to successfully executing on a 1031 tax deferred exchange. Now, I say successfully executing the exchange because that is not an easy thing. This is a sophisticated maneuver. It's something that requires excellence in your approach, okay? And I've been in the business 17 years in commercial real estate. I've kind of cut my teeth on 1031 exchanges, being an independent broker. You've got to do things that stand out when you're competing against the big brokerage firms. So executing these 1031 exchanges has been my niche, okay? And so the first thing that we want to talk about is really having and defining a clear purpose as to why are you doing this exchange. And it shouldn't just be to sell and make a bunch of money or to just simply defer capital gains, okay? The real purpose should be to acquire a better asset and or to move up in terms of more units, a bigger property, or a better asset class. Or by better meaning that something that you want to move into. Let's say you own apartments and you want to move into, let's say, single tenant triple net, which is very popular because in a single tenant triple net property, you don't have any management essentially, okay? But the bottom line is you have to clearly define the purpose of why you're doing this exchange. It's not simply because I want to sell and make all this money and I just don't want to pay taxes. The bottom line is should be I want to acquire a better asset and defer the capital gains taxes, okay? You got to sit down and clearly define that. And then ask yourself, why? Why do I want to do that? And I think the biggest thing that I see as to why is because you may be generating X amount of cash flow. And if you execute this exchange properly, you can double or triple your cash flow. And particularly if you're in a market like the Bay Area where prices have shot up over the period of time and you have a large pot of equity, that is really possible for you to then exchange and significantly increase your cash flow. So number one, clearly define your purpose outside of simply just selling the property and deferring taxes, okay? Number two, have a preset criteria, an investment criteria, clear preset of what you want to exchange into, okay? You don't want to get in the middle of the exchange and be thinking, well, I kind of would like this, or I think that might be cool. Nah, you need to have a very clear preset criteria of what you're looking at. Now, I think that starts with number one, analyzing your current return on equity. I've got a couple videos on my YouTube station where we talk about the return on equity versus the return on investment. And essentially, I won't go too much into it now, but bottom line is you got to look at the equity, the current equity in your property to see how that is performing, okay? In order to determine what your criteria is going to be on the next investment. Bottom line is you don't want to sell, defer, buy a property and now you're making less money on your equity that you were making with your old property. Why go through all the hassle? The whole goal is to make sure that you're advancing, okay? Or if it's all equal dollar for dollar, making sure that if that is the move, okay, that move is done in a way where the asset is better than the one you had. But I think if you look at your return on equity that you have right now currently, and you figure out, okay, if we execute a move in the marketplace where we can double our cash flow, which I see a lot of, now you couldn't agree, so to speak. Now you're making moves that make sense based on the numbers, and you're starting out with that. So you have a clear criteria, okay? Very, very important. It seems basic, but I think this point gets missed a lot, okay? Number 3, very important, know the rules. Now, I say that because a lot of people, very sophisticated people who own a lot of real estate, mess up on some of the rules of 1031 exchange. And believe me, the IRS is very unforgiving in this process. So you don't want to screw up, okay? When I say know the rules, okay, a couple things. Number one, I think it's important to understand the time frames, all right? From the day you close escrow, you have 45 calendar days, not business days. They don't care if Christmas, your birthday, 4th of July, it's 45 calendar days. Now, in this pandemic, There was an extension when the pandemic first started that people got, kind of extension to July 15th. Today is August 14th. The extension is not there anymore. So we're dealing with, you close escrow, you got 45 days, not 46, 45 days to identify. What does that mean? You can write on the qualified intermediary, that is the third party company that handles your exchange. You have to submit to them in writing by the 45th day at 12 p.m. what properties you want to identify to purchase. You don't have to purchase them all, but you have to at least identify. Now, in identification, it works a couple of different ways. The basic way, the way I advise, is you can identify up to 3 properties, okay? Up to 3 properties. Again, you don't have to buy them all, but you can identify up to 3 properties. Now, there's people who say, well, I want to have more options than that. Maybe I want to buy a couple properties, or you're buying a portfolio which has multiple deeds, okay? Now, if you got more deeds or more properties than 3, you have to go by what's called the 200% rule. That is a very, very complicated way of doing it. I don't necessarily advise that unless you are very sophisticated and you've done this a few times before. But essentially, you can identify as many properties that you want to identify, so long as the value is 200% of what you sold. And there's a bunch of other nuances. I don't want to get into that, but it's complex. And if you're going to do that way, the 200% rule way, you need to talk to your qualified intermediary, okay? This is the company that handles this exchange. Oh, and by the way, you need to engage the qualified intermediary, we call it the QI, before you close escrow, because if that money touches you as the seller, your exchange is blown. You have received what they call constructive receipt, meaning the money went to you. Now it's all taxable, okay? All of it, all right? The money has to go from escrow to the qualified intermediary. It cannot touch your hands, or it's constructive receipt, all right? You're paying taxes, okay? So the money goes from escrow, goes to the QI. You got 45 days to identify. Now, after that, you got 180 days to close. Now, here's what I mean by that. 180 days to close. That first 45 days is a part of the 180 days. You don't have 45 days and then another 180 days. From the day you close escrow, you got 180 days to close on one or all the properties that you identify. Okay, very, very important. That 180 days encompasses the first 45 days. Very, very important to understand this. And again, it's 180. It ain't 181. Big point for you to understand. Okay. Now, those are the time frames. All right. Next thing you need to understand is the numbers. Okay. You need to sell. Let's say you sold a property at $1 million. You need to buy at least $1 million of property or more. If you buy $900,000 of property, that difference between $1 million and $900,000 is what's called boot. You're gonna have to pay taxes on it. Okay, on that $100,000. Even if you used up all your money and paid cash for something, but you didn't equal what you sold, that's called boot, okay? And you gotta buy the value that you sold or above. You cannot go below that. Another important thing as it relates to the numbers and what you gotta exchange up into is simple rule here. You gotta spend the cash and replace the debt, all right? Spend the cash and replace the debt, meaning this. Say, again, $1 million property you sell. Say your portion of that was $400,000. You got $400,000 of cash, all right? And then there was a $600,000 loan on the property. In the next property that you buy, again, the purchase price, either, in one property or up to 3 or however many properties you buy, has to total that $1 million. Not only does the purchase price has to total at least that $1 million, you have to spend all of that $400,000, spend the cash, and then this is the key one. You have to replace the debt. You got to take $600,000 worth of debt on in your replacement properties, okay? Because if you don't, it's called boot. So let's just say you found a $1 million property. You sold $1 million. You found a property for $1 million, okay? But you went and got, you had $400,000 and maybe you got, a loan less than the $600,000, Okay, maybe you got a $500,000 loan, and you say, hey, I don't want that much big of a loan. I'm gonna put my $400,000 down, and maybe you added some money to it. There would be then boom, okay? Or let's just say you went out and you sold the property for $1 million, right? Then you go buy a property for, let's just say $1.1 million, $1.2 million. So the values are fine, right? You put all the cash down, and now you're gonna get a loan for, $700,000. Now you qualify because you have to replace that amount of debt or more. You can't go less. You can't sell $1 million properties and say, hey, I'm gonna take my $400,000 and pay $400,000 cash, all cash for this building, okay? You got to spend the cash and replace the debt. A little confusing. I probably do a better job explaining that, but I just want you to understand the simple way to think about it: spend the cash and replace the debt, okay? And as a side note, if you want to take a couple of dollars out of the exchange and just put it in your pocket, you can do that. Just know that that amount would be taxable. That amount is boo. So say you get $1 million, you got 400,000, you say, let me just take 50 real quick. I need to put that in my pocket, or I need to put that in the business. I just need to have that in reserve. You're gonna pay tax then on that 50,000, all right? So again, make sure with this, I wanna make sure if you're talking to your accountant, that's another important piece I'll talk about at the end. Talk to your qualified intermediary. Sometimes it's good to have a couple of dollars in the pocket if you don't have it, or in reserves, okay? And it may be worth paying the taxes. Also, depending on what state you are, the amount of taxes you're gonna pay is gonna differ. Because in California, we got a big, a large capital gain amount. Some states don't even have capital gains. So the Fed, and in California, you have to pay Fed and the state, okay? So that amount of gain is gonna vary on which state you're in, okay? But the bottom line is you gotta know the rules. And a good way of knowing that is to get as much education about the process. That's why I'm always involved in these exchanges. That's why I want to do that. I'm doing this video. I'm going to do more about the topic because there's a lot of gray zones and red zones and people making a lot of mistakes. So we need to make sure we're clear about this because nobody wants to voluntarily pay taxes. Now, I will say this, before I go to point number 4. Paying taxes ain't the end of the world, because if you can't find what you want, you don't want to you don't want to buy a bad property just to avoid paying the taxes. Better to pay the tax, have the cash, now you can do what you want with it. I just want to make that side note because a lot of people get too entrenched into, I'm not going to pay the tax, okay? We don't want to pay the tax, so that's why you have to have these discipline strategies that we're talking about. So number 4, this is, I think, the biggest thing, for keys to success in terms of finding the replacement, is to begin searching for the upleg property, the replacement property, as you list the property for sale or as you enter into contract for the property for sale. If you're going to list it, as soon as you list it, start looking. Okay, if you get an unsolicited offer, as soon as you go into contract, begin looking. Okay, because it takes time to find the right property. Again, we're not just trying to buy any old property. We're trying to buy a better asset, right? A better property, a better investment, increase your cash flow, and go from one type of property to a better type of property. Okay, that requires time, effort, all right? And then I think because of the time frame that I just explained, which are very, very rigid, you need to make sure you start looking before it's close escrow. You don't want to get to close escrow. Now you only got 45 days to find the right deal. Okay, you want to have to start that process as soon as you start selling. That way you can see a wide variety of properties. You can analyze a wide variety of properties. You can make decisions, based on wisdom, not based on time pressure. Because usually that's not the best state of mind to make investment decisions in. Sometimes you have to make decisions in that position. You have to make decisions under pressure. But if we can avoid that, and we can structure a better way, like what I'm saying, and start looking early, now you're gonna have better options of what those replacement property is gonna be. Now, within this same context, when you're the seller, what I like to do as a broker is when we are doing exchange, we like to put a clause in the contract saying, hey, we've got the right to extend this contract out an additional 30 days if we have not found a suitable replacement property. Okay, because with all things considered, If we're priming the pump, we're trying to find a deal, we haven't found one, we just might need a little bit more time. Word to the wise though on this, especially right now, August 2020. A bird in the hand is better than two in the bush, meaning that you don't want to blow a deal because you stretch it out 30 days because the lender might say, well, we need to close now. Okay. A lot of time buyers need more time anyway, so it's not that big of a deal. But if the buyer's ready to close, they got all their ducks in a row, or they're in an exchange, don't blow the deal on this. But negotiate to have it in the contract so that you have that option. And then if you need to pull that card, it's there. You know what I mean? That's why I say put that clause in the contract that you got an extra 30 days to extend the contract out, if need be, to find that replacement property. Okay? Now, point number 5. And I think this is very, very important. Look at a large number of properties. Look at stuff that you don't even, maybe wouldn't even consider. And I say this because I've been in a lot of exchanges. When we get back down to the wire, we'll go back down and say, oh, well, what about this property? Or what about that property? And a lot of times I'll say, well, we looked at it, it's now pending or it's sold or it's not there anymore. When you're initially, like me as a broker, I'm sending properties constantly. When you're initially in that phase of looking for properties, a lot of times the investor thinks they have more time. So they're like, I don't want to look at that. What I'm telling you is take the time to look at a bunch of crap to find that needle in the haystack. All right. It's boring. It's long. It's laborious. Nobody wants to do it. But I think it's important because you might get down to the wire and be like, oh, I don't have anything. Versus if you really spend the time up front going through it, I think that's going to help you to make a better decision. And also, I just think in general, as we're looking for properties to invest in, that you want to kind of dial into the marketplace, meaning that you got to know what's out there. And even if it's all bad, if it's not what you want, at least you have a gauge on what the marketplace is. And that's important, especially if you're going to go outside of a market that you typically invest in, which I see is very, very popular today. And I actually, I think it's a good thing. You sell in a market like the Bay Area and here in California, and you buy in the Central Valley, you can significantly increase your cash flow. You sell in a property in California, maybe buy a property in Texas or somewhere else where the cash flow, the cap rates are higher, you can significantly increase your cash flow. But you have to become familiar, aware, and strategic within that marketplace. You don't want to be a novice, all right? And a good way to do that is look at a bunch of properties, all right? You really get dialed into what the cap rates are, what the rents are, what other brokers are asking for, the flexibility of sellers. All those things are very, very important. Now, bonus here. Well, bonus is, I talked about knowing the rules, right? And so in terms of knowing the rules, there's this thing called like kind. You have to buy a property that's like kind. This is very misunderstood. So I want to break this down as a bonus. Like kind simply means deed for deed. You could sell vacant land and buy an apartment building. You could sell an apartment building and buy an office building. You could sell a hotel, buy a mini storage. But it has to be deed for deed. You could also sell a building, and say you sold an apartment building, and you can buy into an investment with other partners. But it has to be done in a way where you get a fractional interest in that deed. It cannot be done in a way where you simply just get an LOC interest. That ain't gonna work because it's not a deed. You're selling real estate, you need to buy other real estate. Deed for deed, okay? It can't be deed for LOC interest, partnership interest, okay? Or it can't be deed for stock purchase, okay? It has to be deed for deed. But it can be all different kind of, the property type is not what we're talking about, like kind. It's got to be real property, okay? So I hope this helps. If you like this video, please subscribe to this station. Throw me a like. If you thought this was horrible, throw me a dislike, give me a comment, okay? I want engagement from you guys. It's our goal to put quality content out in the marketplace, especially during this pandemic, because we've really never been here before. And there's some things that we can master as we're moving forward. And 1031 exchanges, I think, are very, very critical to the investment market. We need to know how to do it and how to execute them on a consistent basis. Thanks a lot. Y'all have a blessed day and go forward.